Hello, and welcome back to Catching Up to Fi. I'm Bill Yount, and today's guest is Paul Merriman. He's a financial educator, author, and podcaster. Paul is nationally recognized authority on mutual funds, index investing, asset allocation, and both buy and hold active management strategies. He began his career in the 1960s, working briefly as a stockbroker for a major firm on Wall Street. Concluding that Wall Street was burdened with too many conflicts of interest, he decided to help small companies raise venture capital. In 1979, he became president and chairman of a public manufacturing company in the Pacific Northwest, and in 1983, he founded an investment advisory firm, Merriman Wealth Management, as it is now known. When he retired and sold the firm in 2012, it had $1.6 billion under management. Upon retirement, he founded the Merriman Financial Education Foundation, a registered 501c3 dedicated to providing free financial education to investors of all ages, especially do-it-yourselfers, helping them make informed decisions and successfully implement their retirement savings strategy. Paul works for the foundation without compensation. His return is the satisfaction from knowing that he is helping individuals and their families build a more secure financial future. He lives on Bainbridge Island, Washington, with his wife Suzanne, 2 Bichons, and a Chihuahua named Squish. This is part 2 in our series of talks with Paul Merriman. I would refer you back to episode 8 in order to complete discussion with Paul. As an aside, I want to thank our listeners. As of episode 8, we've had over 10,000 downloads. This is an incredible start to a new podcast, and I want to thank you, our listeners, for staying with us. And now, on with the show.
Every 0.5% leads potentially to another extra $1 million. The best portfolio that you will own is the one you will stick with for the journey. Now, market timing typically is what we call the ICSIA strategy. This is the most common. I can't stand it anymore.
Hi, and welcome to Catching Up to Fi, a podcast on mindset, money, life on the journey to financial independence. I'm Bill, and I'm a late starter.
I'm Becky, and I'm also a late starter, and we're your hosts. We're here to help you with your journey to financial independence, no matter where you're starting from.
We're going to talk to other late starters, experts, and we'll explore topics related to our mission.
Join us as we catch up to FI together. So the next chapter in the book is chapter number 10, which dovetails perfectly with this. Put simple math to work for you. In other words, we're talking about dollar cost averaging and automating.
Yes, and there are few guarantees I can make. I can guarantee that if you follow my advice, you will lose money sometimes. And that's a little uncomfortable that somebody would guarantee it, but I can guarantee it. That's the way it works. That's why you get the premium. I can also guarantee that if you take a diversified portfolio, not one stock, not an individual company that could go out of business, but a diversified portfolio like the S&P 500, and every month you invest $100, and if one month it's $10 a share, you're going to get 10 shares, and if it goes down to $5 a share, you're going to get 20 shares. I can guarantee that it will force you to buy more shares when the market is down and uncomfortable. People do understand the idea it's good to buy things on sale in every other part of the world except investing. It's fascinating, but dollar cost averaging makes you do that. So when it goes to $20 a share, it means you're going to buy fewer shares. So over time, it does something that's really important, and that is to keep your commitment to investing during all markets. And the most difficult markets to keep doing it are when the market is down.
Yeah, that's what I do. Every 2 weeks, we get a paycheck. Every 2 weeks, we invest. Doesn't matter what's going on. It's just an automatic situation.
I think that's wonderful. And have you ever wanted to find safety since you made that commitment?
No, I don't care. I try not to. I don't try and follow it. I find it interesting, but honestly, I find more interesting that I bought more shares.
I think that's great. That's a good line.
You don't lose dollars because you maintain the number of shares you have, unless you sell.
Well, sure. Sure. I mean, the reality is when we see these great long-term returns, let us not ever forget that even if something compounded for 10.4% a year for 93 years, the next year it can go down 50%. In fact, Peter Lynch and Warren Buffett have both been quoted as saying, if you're not willing to lose half of your money, you should not be in the stock market. And by the way, what happened from 1939 to 1929 to 1938 was just as bad as from 2000 to 2009. In fact, 2009 lost more money than the market did from 1929 to 1938. It's just part of the process.
That actually brings up a discussion of risk. Risk is an interesting thing to talk about in the investing world, and I think it's often misunderstood. Can you tell us your concept of risk and how we as investors should see it and think of it?
I see risk as any way that I could lose money, loaning money to friends when we were young. I would say that was probably a risk. I think putting money into illiquid investments have a risk about them, because when you want to get out, normally you have to take a reduced price because there's no liquidity. Liquidity risk is real. One reason I love having money in mutual funds, I can get out in one day if I want to. Maybe I'll make less money because I did that, but I'm liquid. So liquidity risk is real. Stock risk is where you could lose everything. You have all your money in one company like Washington Mutual, and it goes out of business. And lots of people that worked for them had all of their savings in WAMU stock. And so that's a risk. Having your money in bonds and getting, for example, in treasury bills over the last 93 years, it's been about a 4% rate of return. But inflation risk has eaten up almost all of that. So every time I identify one of those risks of loss, I want to know what can I do to minimize it. And I can't eliminate it, because if I eliminate it, I'm almost guaranteed not to make anything. If I sit on cash, I'm taking inflation risk with that cash. So how do you minimize stock risk that you put all your money in one company? Put it in 1,000 companies. I mean, that makes sense. And then along come the academics, and they teach us one of the, I think, the coolest things, that the expected rate of return of any single large cap growth company is the average of all large cap growth companies. Well, of course, some are going to do better, some are going to do worse, but you don't know that on the day that you make that choice. But if that is so, that statistically the return of one is the average of all, why wouldn't I want to own all and not take the risk of losing everything? Because you can't lose everything when you own all.
One thing I learned from you in particular with regards to this is volatility is not risk. Maximum drawdown is more likely the way we should think about risk. Is that true?
We show that, yes, that is an important risk. And on our tables, we show you for all the different portfolios, the maximum drawdown. Now, the drawdown is from a peak to a valley. And then when it comes back up to that peak, you have created then the drawdown from the peak to the valley before it earned that all back. That is a very painful period. That painful period of watching your investment go down and then fighting its way back up. And sometimes it doesn't make it up and it goes back down again. And finally, maybe it's 2 or 3 years later before you get back to where you were. That drawdown is emotionally and financially painful. So we need to be able to compare the drawdown of, for example, the S&P 500 versus the S&P 500 and small cap value 50-50. Well, it's a little more for the combination, but very little. On the other hand, there are combinations that will be half of that. That would be, for example, like my wife and I, we are 50% in bonds and 50% in stocks. We don't have to take the risk of the volatility of an all equity portfolio. But that literally cuts our drawdown risk in half. We still got risk. Our kids may not be happy if we die at the wrong time, or they could be very happy if we die at the right time.
Be sure you take care of that, will you?
That's great. That's great.
So, Paul, we hear that there's a couple of things in life that are certain: death and taxes. Can you speak for just a minute about why we want to think about taxes?
Well, I'll tell you, taxes is something that a lot of people, they just do not know about taxes. For example, one of the reasons I don't like actively managed funds is because compared to an index fund, the actively managed fund pays more taxes, about 1% more than the index fund each year in taxes. Now, just to be fair, and Morningstar tracks each mutual fund for this. They look at this difference based on people in the highest tax bracket. So it will be less if you're not in a higher tax bracket, but it will still be relative to the index funds, taxable events, and the actively managed taxable events. But think about that. You could lose 1% in the return, even though, for example, it might say that Morningstar shows that mutual fund made 10% a year. That's before taxes. After taxes, they would say it makes 8.5%. Whereas maybe the index fund shows 10%, but after taxes, it's 9.5%. But I've just noticed after looking at hundreds of funds that difference is about 1%. That's an important tax consideration. Now, you said death and taxes are two things that we know are going to be part of our future. I wonder what's going to happen with people who have parents or grandparents who are going to help them put their money into Roth IRAs when they're very young. I don't mean when they're, well, for our granddaughter, we didn't put it into a Roth IRA. We couldn't. But we gave it to our daughter to invest it in half in S&P 500, half in small cap value, until she can start working and has income, at which time the money is then put into the Roth IRAs, which will then compound tax-free for the rest of her life. I mean, literally, between Roth 401ks and Roth IRAs, you could, in fact, maybe not pay any taxes. Well, they're probably going to find some way to get you. But right now, what is it? About $12 million or $24 million that is protected. So you can, in fact, circumvent a lot of taxes. But then there's sales taxes and there's property taxes. So you don't get rid of all of them. But there are ways to be more efficient, and you should find them. Another way that you can be more tax efficient is putting your bonds in your tax deferred or tax-free accounts and putting your S&P 500 in a taxable account, which would be more tax efficient, or choosing between ETFs and mutual funds, because ETFs are more tax efficient than mutual funds. So taxes are worth considering. There's at least 1% available, maybe even more, depending on how you manage the tax aspects. That's one of the things I just love about the White Coat Investor. The articles that he writes about topics like taxes and conversions to Roths, that kind of work. I don't do that kind of thing. I am not a tax planner. I am just an old investment guy trying to help people get this part of the process done right.
Taxes are important. And what the quote from your book actually is very apropos. It says, a fine is a tax for doing something wrong. A tax is a fine for doing something right. So we shouldn't abhor taxes. If we're paying taxes, we are getting things right, right?
Well, I live that way. And I've I've done the things like when I die, my IRA goes to charity. So I didn't have to convert to a Roth. I just use that money to pass on without any tax implications to the estate. Now, I'm not sure my kids think that's a great solution, but it's what seemed like the right thing to do in planning.
Now we come to the 12th step. This is where it has all been leading, actually. And you are a huge fan of the target date retirement fund, and that leads you to your philosophy of two funds for life. So target date funds are a set and forget it retirement savings option that removes two headaches for investors: deciding on a mix of assets and rebalancing those assets over time. Can you explain that to our listeners, please?
Well, if you were running a pension fund, which is no different in many ways than managing your own money, the pension fund is doing it for thousands of people maybe, and you're doing it for one person. But you have a responsibility, theoretically, to take into consideration how long will it be until you retire. So the people who run if you have working and you have a pension fund, they know you're in there. They know when you're likely to retire. They know when they're going to have to be paying you money. And as you get older, they want to be adding bonds to the portfolio to minimize the volatility. And that's the way a target date fund works. It allows a 20-year-old investor to do one thing, to say, I want to retire in 2065. And you can put your money into a target date fund, which will automatically, for the rest of time, by the way, not until 2065, they just know that's when you want to retire, but they're going to continue to do the right things with your investments to match who you are and how much risk you should be taking. So when you're very young, they're going to be almost all in equities. When you're very old, you're going to be like, for example, at Vanguard at my age, they would have me 30% in equities and 70% in fixed income. And I say, no way. I want to be in more equities because I'm trying to grow the money a little more than being 30% in equities. But what they're doing is good for most people and mostly for conservative people. That's the thing about target date funds, the way they're built. They're built to be conservative, but to do the right things for the rest of your life so that you never have to talk to anybody about it. You never have to worry about it. They're doing all the hard thinking. And here's the amazing study from Wharton and Vanguard. They looked at 1.2 million accounts, 401k plans. Some had target date funds. Some had no target date funds. Either, let's say, target date funds all completely and none. The average difference in expected return from those two groups of people, the one that had the target date funds, was 2.3% more per year than the ones that were doing it on their own, thinking they're smart enough to take care of their own money. Well, the fact is, the reason that their expected return is so much lower is because they had way less in equities. They had a whole bunch of cash. They were sitting on cash. What were they sitting on cash for? Well, at some point, they must have market timed, evidently, whereas in the target date fund, there is no market timing. Now, I think for most people, this is the greatest product that the industry has ever created. Mutual funds started in the 1920s. There are problems with them, as there would be with any solution that is designed to take care of very conservative investors. Number one, they will have fixed income in the portfolio from day one. Are you kidding me? Every 10% you have in bonds is reducing the return 0.5% per year. What does a 20-year-old want to be in a bond for? And it was part of my conversation with John Bogle, and he explained why. They do that because they want them right out of the gate to realize that we are going to be managing your portfolio with stocks and with bonds, and we'll be adjusting the bonds as you get older. But they put that 10% in there. It doesn't protect against a bear market. Oh, a little tiny bit maybe, but a very little tiny bit. You're still going to be down a lot if the market goes down 50%. But just so they'll understand how it operates. And my response was, when I was met with him back in 2017, was, wouldn't an attempt to educate them be a better idea and have them be all in equities and fix the bonds later? And their conclusion was no, that it is more important that they get the feeling of having those bonds in there. So that's one thing I don't like. Secondly, they have very little value compared to what the academics would recommend. And what they will do, and this, by the way, this is the same thing with the total market index. In fact, that's what Vanguard uses in their target date fund for the equity holdings, are a combination of 70% US total market index, 30% international total market index. In other words, basically mostly large cap growth. But they have a little bit of small cap in there. And so they'll say, well, we have enough small cap in there already. No, they don't. It doesn't even move the needle. Remember I said earlier, the return for the total market index is virtually the same as the S&P 500, and S&P 500 doesn't have any small cap value or small cap growth. My point would be, and I want to make very sure, Bill, that I do not take credit for creating that portfolio. That portfolio was created by Chris Pedersen, the same man who chooses our best-in-class ETFs for us. About the time that I had that meeting with John Bogle, and he was criticizing me for making things so complex. By the way, he's one of the nicest people I've ever met. He didn't hurt my feelings. As a matter of fact, he motivated me. He changed my life because that was exactly what Chris Pedersen wanted to do. And so we got to work and we put it together so that we think that we can help people who don't want to make it complex. So here is what Chris suggested. You could do something as simple as let's say you're putting 10% away. You could put 8% in the target date fund, and you could put 2% in small cap value. And just let them do their own thing. Let them grow independently. You don't have to rebalance. There's nothing to do. And that will probably add somewhere between 1 to 2% return over a lifetime of that portfolio. And it will give you exposure. And by the way, by adding some more equities, it reduces the percentage you have in bonds. Not a lot, but some. But then there's another way to apply it. And I just think this is one of the most clever, although it's a little bit hard for some people to swallow. He said, take your age, let's say 20, multiply it times 1.5, 30. That's how much you're going to have in the target date fund. And the rest you're going to have in the small cap value. Whoa, that's a lot in small cap value. Yes, it should be a lot, Chris would say. You're young, you can afford to take that risk. And there's never been a 20-year period that small cap value hasn't out-earned the S&P 500. But by the time you're 30, now it's 1.5 times 30, 45 in the target date fund, and 55 in small cap value. By the time you're 60, it's 90% in the target date fund and 10% in small cap value. And I might mention that not only do we write about two funds for life in about half of our book, but Chris has written his book on two funds for life, and it's an engineer's masterpiece. He is an engineer. It is filled with more numbers than I use and tables of studies that he's done. He is one of the nicest people I've ever worked with, one of the smartest, and I just think he has an absolutely wonderful strategy putting together with two funds, the target date fund and small cap value.
So a natural extension of this portfolio is It's initially geared towards young people. We're late starters. Is this something we can apply to our investment career? Is it somewhere we can start too? For example, I would be in the 90-10 version. Is it a great place to start, or would you recommend something else for late starters?
It is not. He would suggest if you're going to do 90-10 and you're going to do it for life and you're a late starter, he would suggest that you do it 90-10 forever, or maybe even 80-20 forever. And you'll find in his book, he has those studies addressing people who are later in life. And by the way, if you've had success with a strategy for 10 or 20 or 30 years, it's going to be easy to continue doing it because you've had the success and experienced it. And more than likely, you've experienced a bad period too. So you know what it feels like. I really think that for people who are willing to take the time and understand, and we're going to write a lot about this year, the glide path. I would like people to have a glide path that, for example, you use the 4-fund strategy or the 2-fund strategy, and that's your equity. That could be your equity for the rest of your life and not have all that money tied up in those large cap blend indexes. And you control that, so you won't have any fixed income when you're 20 or 30 or 40. You should be doing the fixed income should come after 40. But at your age, would it be inappropriate for you to determine some glide path for fixed income for the rest of your life, and to make the equity part some sort of a combination? Well, you have your combination. You've got the combination of the 5 different equity asset classes that you're comfortable with. So you could combine, and you've got some small cap value, I think you said, Bill.
Correct.
Question is, and this is, I always worry when you start taking more risk than you should, according to the textbooks. See, when you're an advisor, you want to stay within some guardrails. And when people are trying to catch up, sometimes they start taking risks they shouldn't, and they run into one of these terrible times when that was a big mistake to take that much risk. And then you're really behind the 8 ball.
That's a hard question for us to answer. Do you have the answer, Becky?
No. In fact, I'm curious if we're talking about somebody that has 10 to 15 years of accumulation and then say 20 to 30 years of drawdown. So would you suggest that a person have any fixed income, or what asset allocation would you suggest for those short accumulation years, and then compare that to what you would suggest for the drawdown years?
Well, by the way, the professionals will show you what they believe with their glide path, but not every glide path is alike. Vanguard has. They disclose their glide path on their website. BlackRock does. T. Rowe Price does. So you could see how lots of other people are dealing with that. And this is the part of being an investment advisor that I miss. I particularly love the original meetings and trying to find the right combination for that person's needs, because obviously your Social Security and all these other things that are going to flow into your plan are all part of that. Your house, and are you going to be downsizing and moving to a place where it's less costly to live? There are so many of those kind of things. Are you going to keep working part-time? There are a lot of people in the business that believe you don't need to add any fixed income until the last 10 years. And that means, by the way, that you're spending that period prior to that being exposed to losing half of your money. How comfortable is that? Mm-hmm. And so you have to realize that, by the way, if you haven't seen our fine-tuning pages on our website, you will like these fine-tuning, because they show you the return and the risk of 40 from all fixed income to 10 equity, 20 equity, 30 equity, 40, all the way up to 100% equity. So you can see what risk you're taking as you walk into whatever your combination of asset classes might be. it's going to be about luck, Becky. I mean, this is the part. It's a random. This whole thing about sequence of returns is a huge subject, because you can have way more money than you need to retire, and you retire, and your first 10 years looks like 2000 to 2009, a period during which the first 3 years out of the gate, the S&P 500 loses money, and then later in the decade loses money again to the tune of over 50%, twice in 10 years. And that's after it had compounded at over 17% for 25 years. Well, people weren't ready for that. And people also included that the place to be with equities, obviously, is in the S&P 500. Why? Because we have this thing called a bias to recency. And we think something that happened recently is going to be more likely to happen than something that happened 30, 40, 50 years ago. That's not true. Somehow, what really needs to be looked at, and I'm sure you have done this, is you've put actual numbers to what you will have at that end of that 15 years, right?
Yes.
And is it enough if you took out 4% a year to live on? Will you qualify for Social Security?
Yes. Yes. In fact, I'm already taking mine. Mm-hmm.
Oh, you are?
Mm-hmm.
Well, both of you are young, are older than you look.
That is not fair.
Okay. And I'm sure everybody, well, they can't watch. That's right. You guys don't record these as a video.
I don't know if you know Becky's story, but she started with 0 at 50 and retired at 63 with her number. And they've been managing their lives quite well and very fulfillingly. I'm at 57, about mid-path to my retirement. And it looks like it's going to be 63 to 65, depending on the one more year syndrome, market conditions, and sheer exhaustion and burnout in the job. So we both are. I'm not as old as her. Is the bottom line.
No, and I share openly. I'm 67. My husband's 68, and he is deferring Social Security. He was the higher wage earner. He's deferring his Social Security till 70, and I took mine at my full retirement age, and then we'll switch to my spousal benefit.
Well, that's great. We do have a calculator on our website. It's free. It was developed by a young man from Amazon who used our website to do his financial planning. And then when he was done with it, he came to us and he donated it to our foundation. You can go into that calculator and you can run your numbers, your amount of money. You can not only can you choose to accept the historical returns year by year, but you can say, you know something, I don't trust the future to be that good. I'm going to whack 2% off of everything. I'm going to whack 1%. I want to whack 0.5%. You do your own whacking, and then it will spit out the numbers for those
Paul,
adjustments.
There's actually a couple of calculators like that I wanted to get out to our audience. Mike Piper has one with regards to Social Security on his website, and we'll put it in the show notes, but he has an excellent Social Security calculator and is an excellent author that I recommend all people read. The other calculator of sorts I would recommend to our audience in order to understand how their portfolio is going to perform is portfoliovisualizer.com. I found that to be very helpful to understand my asset allocation and what it's going to look like 10, 20, 30 years from now as far as returns.
Yes, and that is for people who want to build their own portfolio. Our calculator is all about the portfolios that we have built. So you're testing your money with our portfolios is the purpose. Portfolio Visualizer, we use that obviously as well.
So there's some special circumstances in closing that we need to bring up because not everybody's going to have access to small cap value in their 401k. What do you do then?
Well, one thing you can do is you can do it with an IRA. If you have an IRA, you can do it there. If your spouse has a 401k that has small cap value, you can do it there. Certainly the point at which you retire, and if you roll over the account to manage it yourself outside of the 401k, then you have access certainly to small cap value. And many people, if they work with larger organizations, They have access to small cap value in the self-directed part of the retirement plan. If you're, for example, oftentimes you have a Fidelity administrated plan, there will be arrangements in the fine print that says you can move the money over to Fidelity and you can do within whatever limits are established. You can do what you want. You can buy small cap value. There's also a thing called a in-kind distribution. And when you're 59, if your plan allows it, it actually allows you to take your money out of that 401k plan and move it into an IRA while you're still working for the company.
Okay.
So there are potential ways to do it.
So there are good workarounds. And you mentioned glide path. I'm not sure that everybody understands that, but we have the target date fund glide paths. And I want to make sure that folks realize that they're not locked in to one target date fund. If they want to take more risk as they get older, they can push their quasi age of retirement out, even though they're going to retire at, say, 2065. They can have their fund in the 2070, 2075 in order to avoid more bonds in their portfolio, or if they want to grow it in what we would call at some way a reverse glide path. And as they age, their risk goes up so that they have more to leave to their charities or their families.
Correct. And again, to make sure people understand glide path, typically we're talking how much fixed income and how much equity, but you could also be talking how much big cap and how much small cap, or how much growth and how much value, whatever. The glide path is just some sort of a formula approach. And again, one of our major projects this year is to formalize some recommended glide paths. We have a very aggressive one on our site that a lot of people follow. That's something, too, that Chris Pedersen has created. And the good news is that Chris Pedersen is not 79.
Well, Paul, we're coming to the close of our podcast today. You've been incredibly generous with your time. We are honored to have you as a guest. We have no doubt this show will be of incredible value to our audience. In fact, we spent so much time talking about your book, it may need to be 2 episodes. Do you have any closing tips for late starters to the path to financial independence at this point?
Well, I think education is always the number one step. And there are any number of sources, I think, where you get a great education as to how this process works. I then think, as I mentioned earlier, it's a pretty touchy situation when you're late. You can't make as many mistakes as when you are starting out. And so I would advocate, like you mentioned, Cheryl Garrett's organization. There's another organization. I'm embarrassed. I do not remember the name, but I'm going to get it for you so you can include it if you would like, Bill. And that is an organization that everybody is only hourly. Nobody is with assets under management, which makes it a little easier to be able to find an hourly person. And then the only question will be whether they have time to work with you. But I really recommend, even if it's only a couple of hours, 2 or 3 hours with somebody who knows this. I know I can sit down. When I was in the business, I would sit down with a brand new prospect, and I would have my yellow pad there, and I would be making notes for an hour or an hour and a half. And this goes back to the days when I was building my practice, and my deal was this: you come to my 3 or my 6 hour workshop, and I don't care who you are, I will give you a free consultation. You don't even have to have any money. I will sit down with you and I will tell you what I think I would do if I were in your position. If you want to do it yourself, here's what I think you should do. So I would sit with these people for an hour and a half, making all those notes. Then I would take the pad and I would turn it over and I would say, I want to see if I really understand where you are. Because if I do, I can tell you what I recommend. And I would never have to see them again. And one thing they would know is that I understood them, because I just asked them the questions that I needed to know to understand what the hot points are. And once in a while, you'd run into a situation like a couple where an airline pilot who was retired had taken his 401k and he put it all in high risk tech stocks in like 2000. And his wife was scared to death. And it didn't come out that she was scared to death until he left about an hour in to use the restroom, and she broke down crying. And the reason she was crying is because she was scared to death, because she thought this was really risky stuff. And what we recommended to them, and they did. And he, by the way, he claimed when he came back and found her crying that he had no idea how afraid she was, how fearful. And what we recommended to them was to split that IRA. The wife could not take the IRA over, but he could give her the right to make the decisions for that account. And that's what he did. And she took a conservative answer, and he stayed the course for a little while. And finally, he too became conservative and turned the money over to the firm to manage for them. But every situation is so different. And remember, when you're trying to be a do-it-yourself investor, you are the advisor to the most important client in the world. I mean, this is heavy-duty stuff. And then you're on one side of the desk, and then you're also on the other side of the desk. So you have to ask and answer the questions. My concern is you're not going to either know the right questions to ask or be honest with yourself because you don't even understand them. In fact, if there's a book I just love, it's Your Money and Your Brain by Jason Zweig. I mean, you read that book and you'd understand we're all a little bit nuts about money. Somebody has to be willing to be able to do the right questions and translate the answer and know to dig deeper. And that's why I think if you can find a good advisor that can do that with you, it can be worth millions. I mean, that's another million right there. And that's only because they ask the right questions.
Well, I think you've helped our investors and our audience, or give them a lot to think about to help them make their millions as they move on to their path to FI and hope to retire on time, in my case. We want to know, too, what lies ahead for you in the future. What are your next projects? What do you have on top of mind?
Well, the biggest project I have right now in terms of the foundation is to help Western Washington University take the next step to build this new curriculum into the present curriculum. Because when you change the curriculum for every student on campus, that is not an overnight fix. So that's a big project, and that's one thing that's high on my priority. My other priority is to find as many ways as we can to reach people, more people. One of the reasons we give away the We're Talking Millions and 2 Funds for Life on our website is because we want people to take that PDF that we send you, read it, hopefully, and then share it with the people that you think it would help. We want to get that book in the hands of 1 million youngish investors. I mean, we're fine with 79-year-olds and 69-year-olds, but boy, if we can get to the 19-year-olds, and if anybody went and read the reviews from the readers of that book, a number of those readers are high school students. And one of the things they mentioned is they read it and then they went and opened an account. I want that book in the hands of more people, and Chris's book. So we got lots of work to do. I also had to figure out what the future of this foundation is, because I'm not going to live forever. And I got up at 1:30 this morning to start working. So, I mean, I'm crazed. This is, by the way, one of the reasons. This is not good news. I've spent my life kind of being this way, and it's not an easy person to live with. But I've got to figure out how we're going to pass this along to others to continue the work, because there is nothing that's a better income for me than the thanks that we get from people in writing for what they've gotten off of our site. Chris Pedersen feels the same way. Daryl Balls feels the same way. Our He's the one that creates this almost 200 tables that will be up on our site within the coming weeks. These people are really committed. They don't get one penny of compensation, nor do I. They all are just volunteers, and they're smart people. They're engineers. They're software people. I'm just an old-fashioned salesperson who loves teaching. That's all. I mean, I have never done an Excel spreadsheet in my life. And I would imagine there are a few people in our industry that could say that. Now, they would, but by the way, I always worked with people that could.
Becky will be happy to help you out.
I love my spreadsheets.
Take care of yourself because you have so much to offer this community. You can be reached at paulmerriman.com. There are so many resources there. I have learned a ton. I'm sure Becky has learned a ton. And on behalf of both of us, I want to thank you from the bottom of my heart for all the work that you do and all the time that you spent with us today. We get the same kind of feedback. We've had people open accounts. We've had people come clean with their finances. They've been begging to hear this message that they're not alone. With you in the world, we all know we're not alone.
And by the way, it is paul@paulmerriman.com.
Oh, that's very nice of you. They can reach out to you personally then.
They can.
Well, this has been wonderful.
Thank you, Becky. It has for me too. I appreciate it. And I wish you well with this new effort, this business. I just love what you're doing. And I think you're going to have a lot of fun.
We are. We hope you've enjoyed this episode of Catching Up to 5. We would appreciate it if you could leave a 5-star review so that our message can reach others.
We are not lawyers, financial advisors, accountants, or tax experts. Please consult your own professional advisors before making any important decisions. Our content is for entertainment and education purposes only.
We'll see you next time on Catching Up to 5.